Warren Buffett has accumulated over $135 billion in wealth. That's enough to buy pretty much anything in the world. Any NFL team you want, the world's most expensive super yacht, 270 Gulfstream G700 jets, or 135 million years worth of Netflix subscriptions. I wonder what movies people are going to be watching by then. Anyways, almost all of his fortune came from investing. He didn't invent something new. All he did was sip Coca-Colas and decide which companies he should put his money into. And because I want to be a billionaire too, I spent the past 6 months analyzing every investment he has ever made. And in this video, I'll be breaking down the 5 pillars of Buffett's investment strategy so that we can all become multimillionaires over the next decade. And his first rule is that you should never rely on cash. Warren Buffett hates cash because it's sure to go down in value over time. That's why you should invest in assets that can help you outpace inflation, such as stocks. Now, should you just blindly put all of your cash into the markets? No. It's smart to keep a portion of your net worth in cash so that you can take advantage of opportunities when they arise. But you're better off investing your money so that you don't get hurt by inflation. And the best way to do that successfully is by finding your unfair advantage. Buffett's next rule is that you should only invest in things that you understand. And he does this himself too. When he considers investing, he learns everything that there is to know about that business. He reads annual reports, reads articles on the history of the company, does background checks on the executives, everything. If you understand what you're investing in, you can make better decisions because you have a feel for how that business will react to changes in the industry, for example. But you can only do that if you truly understand the business. And if you truly understand it, you can also spot big opportunities when they pop up. Many people have the complete wrong mindset about investing. They get their paycheck every single month, take off their taxes and their mortgages, and then spend what's left on groceries and fun activities. And if they have something left at the end of the month, they might consider investing it. This will never get you anywhere. Most months, you won't have anything left, and you'll certainly never get to investing a consistent amount every single month. When your paycheck comes in, the very first thing you do is take out the amount you want to invest. Then you want to pay your taxes, your mortgage, and use whatever's left to live. You don't need all that fancy stuff anyways. Warren Buffett is worth $135 billion, and he still lives in the same house he bought in 1958 for just over $31,000. And he always drives modest cars. The best way to grow your portfolio quickly is simply to invest more. And to do that, you either have to live below your means or make more money. And trust me, even a small amount of money extra every single month makes a big difference. And this next one is probably Buffett's most important advice of all. For anyone who wants to invest, he tells them to start as early as they can. If you don't find a way to make money while you sleep, you'll work until you die. That's one of Buffett's most famous quotes. And that's why he himself started at the age of 11. If you start investing at the age of 30 and put $100 a month all the way until you retire, by the time you're 70, you'll have a total of $310,867.82. Now, if you start investing just 10 years before that at the age of 20, you'll have a total of $688,524.19. But don't worry, there are still lots of opportunities ahead of us. One of the big ones right now is obviously AI and machine learning. There are stocks that you can invest in, much like Nvidia and in Microsoft, but there are also other ways. I personally love using AI algorithms to help me trade. But if you choose to do the same, you need to deeply understand how they work, or else you're playing with fire. Let me help you. AI trading bots are software programs that use artificial intelligence to analyze market data and make trading decisions. They operate based on algorithms designed to maximize returns and minimize risks. This sounds like something that just works without doing anything, and it is, but it's still key that you actually understand what it does and why it does it. And you can do that by investing in yourself. Find someone who already understands that bot and ask or pay them to help you learn about it. If there's one thing you should take away from Warren Buffett, it's that there's no better investment than the investment in yourself. Books are a great start. Warren Buffett is known to read for about 6 hours every single day. Here are the books he recommends to every new investor. The Intelligent Investor by Benjamin Graham. This book is often considered the Bible of value investing. Security Analysis by Benjamin Graham and David Dodd. Another book read by Buffett, this one dives deeper into the concept of intrinsic value. Common Stocks and Uncommon Profits by Philip Fisher. Buffett recommends this book because of the insights into the deeper analysis of companies. The Little Book of Common Sense Investing by John C. Bogle. This book talks about the importance of having a long-term view. Business Adventures by John Brooks. This one is a collection of old business stories that Buffett likes because the lessons in them still hold true today. Investing in yourself is so important because the market will keep changing. That's inevitable. What matters is not how the market changes, but how you react to it. And there will be risks. That's a guarantee. Buffett has 2 rules when it comes to risk. Rule number 1, never never lose money. Rule number 2, never forget rule number 1. That's also why Buffett has never touched Bitcoin or any other form of cryptocurrency. Sure, the potential profits are high, but the potential losses are too, and the numbers back this up. Let's assume an initial investment of $10,000 with a consistent small 5% gain each year for 10 years. After 10 years, you'll have made $6,289. That's a total increase of 62.89%. Now let's consider the same $10,000 investment with a mix of big wins and losses over that same 10 years. In this case, after 10 years, you'll have made $5,059. That's a 50.59% increase. But if you think you can consistently get big win after big win, let me take you out of that dream. You can't. No investor in history has ever been able to do that, even Buffett. But that doesn't matter because, as you saw in the previous examples, you can make a lot of money if you just get a small profit every single year. The compounding adds up. You just have to think about how to manage risk, because there's always some sort of risk involved with investing. But if you manage this risk well, there's nothing to worry about. Here's my advice. Your main goal should be to keep your money instead of chasing high returns. Think of your capital as the foundation of your investing. If you make sure you keep it, you know you'll have the means to continue investing and growing over time. That's why you should never risk more than 1 or 2% of your total portfolio on a single trade. This way, even if a trade goes wrong, you'll be able to manage the loss. Another important thing is to have a plan and to follow it at all times. Know that you're taking certain investments and leaving others on the table. Know what you enter and what your goals are from that specific investments. This is important because it helps you take the emotion out of it a bit. And that's how Warren Buffett made $135 billion with his investing strategy. However, investing requires time and effort to learn, and you may have to deal with losses before you even start making money. That's why I decided to create my own AI trading bot to skip the learning phase and do my trades for me. Click here to see how that works. I'll see you on the next one.